Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I've got my trusty co-host again here, Scott Stage, our SVP of Marketing, Customer Satisfaction. I forget how many additions you have on there now.
All the above.
All the above.
Good to be here again, Jamie.
Awesome. So Scott, we're sitting here at the end of March. We're both about to get on a plane to Barcelona to head out to our European HQ. But how's the sort of beginning of the year been treating you?
It's great. You know, I'm a little mad, Jamie.
Really?
It's March Madness. Come on. Today starts March Madness. I don't know if you're a college hoops fan, but I've got the madness. So hopefully my bracket doesn't get busted too early. But have you picked your Final Four?
I'll be honest, I have not even looked at it. I have no idea which teams, and the only sort of reminder you just reminded me of is that I needed to do our office pool on March Madness. But am I already too late?
I think you are literally 2 minutes too late.
Next year.
That's all right. Well, let's jump in. Today we're talking about February's performance. You know, overall, I don't think short-term rental operators are mad. Just play with the mad theme. But we have some good data here. I think on today's episode, we'll talk about what we're seeing in the economy broadly and those macro impacts onto the short-term rental industry. We'll talk about how supply growth has changed year over year. Some interesting demand changes. We may look at leap days impact, and then have a forward-looking view into the rest of the year.
Yeah. And I personally just got done with the Hunter Hotel Conference, of which they had multiple economists, multiple sort of travel data providers sort of up on stage digging in, and excited to share sort of what not only I've been seeing in the data and our data, but also and what we're seeing in the rest of the travel industry, which is, there's so many moving parts right now with the drop in the stock market and with what we're seeing in terms of still relatively good economic figures. So much to dig into.
Well, why don't we start there? I mean, first of all, way to represent the STR space in a room full of hotel folks. But what are we seeing economically? Of course, a lot going on, a lot of moving parts here, from tariffs to taxes to recession concern to the markets. What does that mean for travel and short-term rentals?
Yeah. And maybe I'll just start with what I started my presentation with, because we're short-term rentals, and I want to know what's happening in short-term rental demand. And it's how I started my presentation of what are we seeing in the numbers? And we've got not only monthly data, but I got some really recent weekly data to share, and as not really since COVID that I've actually been interested in looking at the weekly data. But given that we've seen so much move in quick succession, so it's actually really interesting to look at the weekly performance. But if we look at February, sort of removing out leap year, we actually saw demand do relatively well, up 5%. And when you look at that relative to the past 6 months, average was about 4.7%. So I'm feeling actually pretty good. Caveat though, if we look at the first 2 weeks of March, demand's actually down. So how is that happening? When we look at monthly nights booked, so remember, the difference between that and demand is demand's based on the month of the stay, and nights booked is based on the month that the reservation's being made. So in February, we saw a 3.3% increase in nights booked, which was significantly less than the 6-month average of 6.7%. And now what was getting me really worried as we looked at on a week by week throughout February, first 2 weeks of February, nights booked was relatively strong, averaging about 4%. Then the week of February 22nd, right when sort of tariffs were all going, and we saw the stock market really start to give back a lot of gains, and bookings were flat. And then the last week of February, bookings were down 4%. So bookings really deteriorated throughout the month, where you're 3.3% in February is looking pretty good. And you look at it on a week by week basis, and it's like, all right, the first 2 weeks of February were good. The last 2 weeks were
Really gave up
pretty poor.
ground. Yeah.
Yeah.
I mean, Jamie, in that point, is it fair to say, it's hard to say any of that's causal and could be correlative, but when you put all of those puzzle pieces together, there's this broader consumer sentiment that may be a question mark or uncertainty or concern about the future and their dollars in pocket, which could lead to constraining their bookings or future travel plans.
Yes, but with a major caveat around, you got to look at what was happening the year prior. So we had always expected March to be a weak month for both bookings and demand because of the Easter shift. And right now, and last few weeks of February into early March, like that's when people would be booking for travel for Easter last year, which was the last weekend of March. So sort of 2, 3, 4 weeks ahead of time. So it could all just be noise and just be the year-over-year change with the Easter shift. I mean, it could be sort of a indication of a broader sort of travel slowdown. But if we look at the first 2 weeks of March in terms of booking activity, we've definitely reversed that trend a bit, where nights booked were up about 2%. So if that trend in February would have continued down, I would have been on here being like, Scott, like, I'm really worried. Like, we could be seeing a really strong pullback in booking behavior right now as we head into some of the most important months or weeks of the year for bookings as people sort of book spring break and summer travel. So 2% isn't great. We're still seeing supply growth of about 4%. So we're going to be talking about probably occupancy declines in March and April, or March, and then maybe probably a bit positive because of, again, an Easter shift in April.
Yep.
Yeah, but March is more than likely going to be a weak month and maybe even weaker than we would have otherwise expected.
Well, you started to call out some of the performance. Why don't I give a quick snapshot of some key metrics, and then we can dig into each of these in greater depth. So if you look at RevPAR, we saw a 5% year-over-year jump to about $177. Available listings were at 1.55 million in February, so up 3.9% year-over-year. You talked about total demand rising 5%, and then occupancy. So just shy of 1% lower, so 0.8% lower year over year at 54%. Let's go there because we've been talking about supply on each of these market review episodes. Is it fair to say we're starting to potentially see supply growth stabilizing?
Yeah, and supply growth has really been plateauing really the past few like 5 or 6 months at right around 3.5 to 4%. And that is, and for me, pretty remarkable that one, we've come down that low and then sort of pause there. But that 3.8, 3.9% really masks the fact that, and this is a local business, and like no market's actually growing at 3.9%. So an interesting stat I pulled for you that I didn't give you the heads up on is sort of the distribution of that sort of our 317 markets in the US and how much sort of each of those are growing. And what I found really interesting is in February, we actually had 63 out of the 317 markets that had supply go negative. So we saw fewer listings this February available than the February prior. And if we were sitting back here at this time last year, the number of markets that were declining was only 14. So we've seen a significant increase in the number of markets where supply is declining. And then the markets where we're seeing more than 10% growth is 59. And if I go back to, let's say, February last year, and how many markets were growing at greater than 10% growth, it was almost 200. So we've really seen a pullback in the number of markets that are seeing real outsized growth, where it's really hard for demand to grow at greater than 10%. And in those markets where you see supply growing greater than 10%, we're typically seeing occupancy declines. And then,
Jamie,
more and more markets going negative.
Are there commonalities across those markets where you're seeing the pullback?
Yeah, I thought you were going to ask that. And so I was looking into it, and like The honest answer is like, no. Like it is, a wide swath of markets. Like some are expected, like Asheville's down 12%, impacted by hurricane. Like, but then you've got Big Bear down 8%. You've got Steamboat down 7%. Some markets maybe, ski markets, maybe a little bit of pullback with the supply growth that we've seen or regulation going to those. But also we've got Boise, we've got Phoenix, we've got Fort Lauderdale, we've got Joshua Tree, we've got Boulder, we've got San Francisco, we've got Orlando, all markets with declining supply.
And then what about in the top 50? Any commonalities there in terms of growth?
The ones growing
Yes.
more than 50? Yes. And it's essentially like a lot of the rural areas of the country. So outside of our large, mid-size, and sort of destination markets, we're really seeing really strong growth. And then also in quite a few of the college towns, they have done really well in recent. So we've got Oxford, we've got Mississippi, we've got Syracuse, we've got Tuscaloosa, we've got College Station. So maybe that's how I'm actually going to pick my college, my
there you go.
NCAA bracket is all these college towns seeing really strong growth. So yeah, maybe I'm cheering for Alabama if they're actually in it.
They are. I mean, I think it's really good analysis, Jamie, because I think it reinforces the importance of doing your individual and local analysis. Because you could sit here and look at this on a macro scale and say, oh, great, 4% growth. But as you just uncovered, you dig deeper and the majority are actually seeing decline. I mean, this is almost like the data you share reminds me of, it's almost like the S&P 500. It's like buoyed by the Mag 7. And when you actually look into the majority, it's a totally different story. And that can be true for a lot of the data and metrics we share, which just reinforces get into AirDNA and go into the specific details at your local market.
Yep. And one of your favorite markets, Indianapolis, our fastest growing market, up 32%. So,
well, yeah, fastest growing for supply as an existing operator.
maybe not very exciting for you. Yeah.
No, that's 2 thumbs up for me. It means there's short-term rental interest in the market. All right, Jamie, so that's supply growth. Let's talk ADR and repeat rent. So in Feb, we saw ADR increase 6% year over year, which this time effectively matching the growth rate of the repeat rent index. Shed some more light on that for us and why that's important.
Yeah. So this is, and the difference there, and we track all guest paid ADRs. So what is guest paying for a stay? How does that compare to last year? And as you said, up very strong. And then separately, like on a listing by listing basis, how much are hosts actually able to raise rates on their existing listings, which we call our repeat rent index. So what we had been seeing is supply really getting larger. So more large listings, more nicer listings, which was pushing the guest paid rate up, even all the while sort of repeat rent was flat or even slightly declining. And what we see now is the gains that we're seeing in guests paid ADR are actually flowing through to the host, where they're actually able to see and sort of push forward rate increases, which is one of the best ways to actually increase profitability in the revenue that you're earning. So for me, this is one of the strongest indicators that things are actually starting to do a little bit better for the average short-term rental operator. Though again, like this can vary dramatically by the property, the market, and the So, you can't get around the fact that this is a positive indicator that we're looking at now.
Again, I think we've probably said this in the prior 3 versions of this episode. That tends to make sense as we think about the stabilization or declining growth rate in supply. It means there's fewer listings available, less competition for you as a host, fewer newer listings coming on market means you can, in theory, be charging a higher price for your home so long as demand stays intact. All right, Jamie, we also saw in February a couple notable and large events. I think it just reinforces the value of being a short-term rental operator. Let's start with maybe the big one, the big game, the Super Bowl in New Orleans, what did we see from a market dynamics in New Orleans?
Yeah. So, did you watch the Super Bowl?
I did. It was not the most exciting game.
What did you think of the halftime show?
Wonderful, wonderful performance.
I agree. Yeah. So, we did see sort of games in New Orleans. So unlike what we saw in Phoenix the year prior, where it was pretty much a bust for short-term rental operators, in New Orleans we actually saw a 30% or 35% increase in ADRs, where New Orleans really led the country for ADR growth because of that. So and super exciting there. And New Orleans had Super Bowl, then Mardi Gras, and really a big month. But New Orleans is on really high up on my watch list now on what's going to happen. They've got quite a bit of sort of regulatory changes coming into that market. Fortunately or unfortunately, the city sort of delayed enforcing those regulations until after Mardi Gras, which is kind of like having your cake and eating it too, or however that phrase goes. So yeah, definitely will be on our watch list to see, like, do we start to see supply impacts and how that impacts existing hosts in that market as we see the new regulations start to flow in.
And then what did we see for the Cowboy Carter tour?
Yeah. So Beyonce launched her new tour coming up this summer. And it was actually funny. I sort of was seeing it live. I was doing a demo to a client and like showing Atlanta and like bookings and like how they're looking going forward. And I was like, wow, like what is this huge bump in bookings that just happened? And like I had no idea. But and we've seen a massive increase in bookings in some of these markets, sort of Atlanta, Houston, Chicago, where people are booking. She's also going to be adding in a few stops in Paris, London, going up to DC. So really across the board, and we're seeing strong bookings, except one market. Can you guess what market we're not seeing an increase in bookings around her tour?
I don't know her tour stops, so
Come on, Scott. The one market we're not seeing an increase in bookings is Los Angeles. And I suspect a lot of that's like there's so much demand maybe in market and we're not seeing, like Atlanta, you're going to have people coming in from all around the Southeast, Houston, and all around the sort of Texas region, Los Angeles, and one of the biggest MSAs. I suspect that they can fill those arenas with just the people in Los Angeles.
now obviously Beyonce, Super Bowl are massive events for those markets. Not everybody listening to this operates in markets where the Super Bowl takes place, or much less another large concert. How should like a typical host listening to this be thinking about events in their area, even if it's not to the scale of a concert of this size? How should we be looking at future pacing, pricing, monitoring demand for surge events?
Yeah. I'm the one page now I go to as a short-term rental host is my pacing page. I'm looking at market pacing. I'm not doing it every day, but I'm doing it every week of what does the forward demand look like in my market? What days are seeing pops? And one of the neat things that's included in the chart is not only the total number of bookings on each day, but also what's been booked in the last 7 days. Because that gives me my indicator of like, all right, what nights are actually seeing a more recent increase that could indicate sort of a newly announced or new demand driver. Because it could be an event like Beyonce, but it could just be like, and your neighbor's having a wedding, or there's something going on in your neighborhood, like a block party or something that's causing an increase in demand of people wanting to stay. So that's something, and just like when I was looking at the Atlanta data of like, oh, wow, a huge pop recently, like I was prepping for doing a presentation for the Atlanta Hospitality Alliance and like our short-term rental alliance. And they were like, oh yeah, like we've already been seeing the bookings and we're still a few months out. So that's something that is really sort of top of mind for me. It actually reminds me of a point I wanted to make about some of the data I saw at the conference I was at yesterday, and it centers around government bookings. Because with all the turmoil we've been seeing in the with Doge and sort of cuts to government spending, Calibrate's a hotel data collector, and they're actually able to break out so how many bookings actually come from government employees and using sort of government discount codes, and it makes up about 4% of demand, which I think 4% of demand, like, oh, that's not a ton, but in quite a few markets, you think like Fayetteville, North Carolina, Huntsville, Alabama, Columbus, Georgia, where there's a lot of sort of federal government employment, either because of a base or research labs. Over the next 30 days, they're seeing a 79% decline on a year-over-year basis in government bookings.
Wow.
So 4% of demand, 80% down, essentially. Like, that is going to have a meaningful impact on sort of travel performance. And then you sort of marry that with some of the other things that STR sort of pointed out, and they're seeing demand growth slowing for hotels. It was only up 1% in February after growing 1.7% in January. So that's an incremental slowdown. But then you actually like start to decompose market performance. Most of that 1% growth was from LA and hurricane impacted markets where they're seeing a lot of displacement. So you remove that out, and average growth in January and February was only 0.2%. And so essentially, right now, we're seeing no growth in hotel demand. And then add on top of what we're seeing on the government side, looking at the sort of inbound flights from Canada, we're starting to see a decrease in inbound flights from Canada. We're already down 2% in February, and we expect that to accelerate further. So definitely some worry about there. Our friends at Tourism Economics have revised their inbound travel forecast, where they had been expecting inbound travel to the U.S. to be up 10% in 2025. They've now revised that to down 5% for the year. Massive swing, 15-point swing. And for short-term rentals, like, I think most destination markets, so you think like the Panama cities, the Destins, there's not much, if any, international inbound. But for the industry as a whole, it's sitting around 13% right now. And quite a few of those sort of major MSAs, so like a New York, Miami, San Francisco, LA, even the Atlantas, Houston, Dallases, it can be anywhere from 15 to 30% of demand. So it could materially impact those markets. And then you think about Florida, South Florida, and the snowbirds coming down. I suspect we're going to be seeing that data impact on those markets once we sort of dig into the February and March data.
Good stuff. Thanks for bringing that in. Let's final topic here, Jamie. The looking forward. So a nice transition to what you were just covering. I think next time we're talking about this, we'll be covering St. Patty's Day. Anything you're seeing in the St. Patrick's Day data yet?
Yeah. So some of my favorite St. Patrick's Day cities are Savannah and Chicago. So do you watch the sort of river getting dyed green?
I don't proactively tune in, but it shows up all over my Instagram because I grew up in the Midwest. So everybody's in Chicago.
Yeah. So yeah, there's not many markets where it's actually a significant driver, but Chicago and Savannah definitely see it. Savannah, you're actually seeing bookings down a bit compared to last year. And so, and maybe suggesting travelers are extending their stays into the week instead of the weekend because the demand's up actually a bit midweek, down during the weekend. It's a little bit worrying that we're seeing it down, but and maybe a bit exciting that people are willing to take a longer stay for St. Patrick's Day if you're going to make that trip.
Love it. All right, Jamie, what's your maybe one statement to summarize how you think the first half of the year for the short-term rental market's gonna play out?
Yeah, and it was definitely a solid start to the year. and no ways to get around it. Like, and demand, ADRs, like we saw, and occupancy first 2 months, and you average out, and January and February, you're essentially flat, like feeling pretty good. But all that said, like the forward indicators are starting to get a bit worrying. So, I'm not calling for a recession. We're not revising our forecast down significantly for the year, but there's definitely some worry. I think there's broad worry across many sectors of the economy. And Delta sort of called it out that they're seeing a significant pullback in corporate bookings. At the hotel conference I was at, I'm talking with hotel brokers, which I think of like hotels just as like big short-term rentals. They are seeing really a pause in sort of transaction activity of like, I don't feel comfortable buying this hotel because I don't know if we're going into a recession in the next few months, where people have been really excited with the new administration and a very investor-friendly environment that the start of 2025 was going to be pedal to the metal, engines roaring, and now it's like it's pencils down. Like, we got to see what happens with tariffs. We got to see what happens with the stock market. We got to see a jobs report or two. So I think everyone is sort of eyes on the economy and sort of what's going to happen.
Well, maybe my takeaway from all of that is so much uncertainty just reinforces, again, the need to be an expert on your local market, because things could change very quickly at the federal level, or at the national level, at the international level, but that may not always flow through to your local market. So be an expert on your local market is my takeaway and my recommendation going forward. Jamie, really appreciate the conversation today and the expert analysis as always.
Yeah, this was fun. I hope everyone enjoyed the sort of deep dive and feel like it was a bit more sort of wide ranging in terms of the data points we're able to get into today.
Only on the STR Data Lab can you talk about brackets and the economic outlook of the country.
All right, Scott. Thank you.